Hi everyone, and welcome back to another episode of Technical Analysis for Beginners by Exo Ventures Consultancy. As some of you know, my name is Daniela and I'll be guiding you through this series. And if you're new here, this series covers different topics within technical analysis, such as price and candlesticks, support and resistance zones, trends and trend lines, moving averages, different indicators, and so much more to get you ready on your trading journey. If you find any of this informative, entertaining, or you just like the video, please make sure to hit the like button on this video. Make sure to subscribe and hit the bell notification to follow along with all the next episodes of this course. And also please make sure to view the other episodes. Episode 1 was about price and candlesticks. Episode 2 was about support and resistance zones, to make sure that you're up to date. Even though we will give you a short recap of those, it's very, very good to just go through them. Enhance your trading knowledge. Right, in this episode, we'll be discussing moving averages. I'll give a short recap of what technical analysis is, since this is the Technical Analysis for Beginners course. I also give a short recap of what we discussed in episodes 1 and episodes 2, and then we get into it. I discuss and explain what moving averages are. I discuss the different types of moving averages and which ones are used most often and most commonly. And of course, I teach you how to use moving averages to improve your trading. Right, as usual, before we do get into the content of this video, please make sure to take this disclaimer into account. This video is not financial advice, it is not investment advice, it does not constitute an offer, a solicitation to offer, or a recommendation of any investment product. It is for educational and entertainment purposes only. Please do your research on anything that is discussed within this video and any other content provided by Exo Ventures Consultancy. And if you've seen any more of our videos, then you already know the drill, but always validate and verify everything for yourself. Do your own research on anything that you hear, read, or see online. Right, now with the administrative parts out of the way, let's get into it. Right, so I'll start off by giving a short recap of episodes 1 and 2. In episode 1, we started off with basically discussing what technical analysis is, and to get you up to date on where we are, technical analysis is basically the financial analysis method that uses different patterns within the market data to make predictions about where price is going next and to identify different trends. The trend is the general direction that the market is moving in. Okay, in the first episode, I teach you how to read price data from the charts, specifically how to read candlestick charts and candlestick patterns. This image that you see before you on the presentation is a candlestick, and it gives you the following price information. It gives you the opening price of that time frame, the closing price, the highest price, the lowest price, and finally if the opening price was higher or lower than the closing price. So that was episode 1. In episode 2, I discussed support and resistance zones. A support zone is basically an area that has a lot of buying demand or buying interest. So basically buyers are stepping in, and as more people are buying, it pushes the price up from this zone. A resistance zone is the opposite, the flip side of this. It's basically an area where there's a lot of selling interests or supply, and as more traders are selling, it pushes the price down from this zone. Right, so let's get into the topic of today's video, which is moving averages. A moving average is also known as a moving mean or a rolling mean. Basically, what a moving average is that it's a technical indicator that smooths out and simplifies price data in a line. And if you remember in episode 1, we briefly discussed line charts, but moving averages aren't exactly the way line charts work. A moving average is a line that follows the price data and is constantly updated with the average price or the mean price of a certain number of candlesticks. So the line chart has the price updated for each candlestick, but a moving average is an average price of a set number of candles, not just one candle. Okay, so there are different types of moving averages. First, we're going to start off with the simple moving average, also known as SMA. Moving averages are also known frequently as MA, moving average. And basically, the simple moving average is just a line that is the average price over a specific number of candles. How you calculate it is you take the full sum of a specific number of candles divided by that number of candles. And then you get an average price for that period. And that's how the simple moving average is calculated. Next, there's the exponential moving average, or EMA, which is similar to how the simple moving average works, but the main difference is that the EMA weighs more recent price action more heavily than older price action. Now, if you've watched episode 2, which I do highly encourage you to do that, you probably remember that I mentioned that it's much better to take recent price action more seriously than older price action. And the reason for this is that more recent price action is more relevant to traders, and more traders are going to be looking at more recent price action rather than older price action, which is exactly why the exponential moving average was invented, to take more recent price candles more heavily into consideration than older price candles when you're taking a span of time into account. There's also a very specific moving average indicator that uses the exponential moving average, and it basically gets calculated by subtracting a longer term exponential moving average from a shorter term EMA. And basically, this indicator is called the moving average convergence divergence, or MACD, and it is used to indicate the momentum of price and the overall trend that the price is moving in. So, moving averages simplify and smooth out price by providing an average over a specific period of time, and this is used to give you basically an indication of the trend and momentum of price. So what are the most common or most used moving averages? Whether you're using SMAs or EMAs, moving averages are highly customizable. And with this, I mean that you can change the settings of the number of candles that you want. And basically this way you change the time period that you want to use and see the average price for. Now, the most common moving averages are the even numbers like 10, 20, 50, 100, and 200 period moving averages. And you can use these moving averages on whatever time frame that you like to chart on. Next, some traders like using the 8 and the 21 moving average, and some traders also like using either the 12 or the 13 with the 50 period moving average. Now basically, the moving averages between 8 and 13 are very useful for very short-term trading. The moving averages that are in between 20 and 50 are medium-term, and the 100 and 200 moving averages are obviously a longer-term indicator, and they also have more of a lagged effect on smoothing out price data. Right, so now that you know what moving averages are, what are the different types, and which are the most commonly used, how do you actually use moving averages to trade? Great question. I'd love to answer that for you. Basically, you can use moving averages in two different ways. The first is to use moving averages as an indicator of the trend of the overall market. And what this does is it gives you an indication on whether to have a short or a long bias for your trades. For example, imagine that the trend is moving up, then you know that ideally you want to take longs rather than counter trade with shorts. And the second way is to use moving averages as support and resistance zones for your trades. And this gives you indications on where to place your entries, exits, and your stop losses. So as a trend indicator, you can use the moving average as a signal on whether the trend is in the market is in an uptrend or in a downtrend. And if the market is in an uptrend, you can start looking for longs. If the market is in a downtrend, you can start looking for shorts. If price is above the moving average, then typically the market is in an uptrend and you can be looking for longs. If price is below the moving average, then generally price is in a downtrend and you can start looking for shorts. Okay, so for long-term and higher time frame trading, a golden cross is generally a green light for a bullish swing trade. What this means is that basically when the 50 period moving average moves above the 200 period moving average, then you can start looking for longs for swing trades. This is called a golden cross. And conversely, a death cross is usually an indicator that you should be exiting from bullish trades and potentially entering bearish trades. A death cross happens when the 50 period moving average moves below the 200 period moving average. Okay, so if you're using moving averages as support and resistance, then this area, wherever the moving average is, can be your indication of where to enter or exit from the trade. Let's give an example. If price is below the moving average, then as you know from the previous section, this probably means that price is in a downtrend. If you still choose to take long trades even though the market is trending downwards, then you can use the moving average as an area to take profits or exit from the trade, because you know that very likely if price reaches the moving average, it will reject from it as resistance because the trend is moving down. So then you can take a long trade, add your take profits wherever the moving average is, and then you can secure a successful trade. Conversely, if price is above the moving average, then price is likely in an uptrend. And then you can use, for example, the moving average as an area to enter longs and then go up with the market. Now I'm going to use some charts to give some examples of using MAs. So this one we have the MA as a trend indicator. As you can see, the trend is upwards. Now let's make some trades using this as an indicator. So here we can see the different areas where price came back towards the moving average. All of these different areas, price came back and basically touched it before moving back up to continue the uptrend. Over here it did break down, but that's fine. Now let's put it over here. We have a little support area, and then we have the price moving towards the MA. This is your invalidation zone, and then you have a very great risk reward trade using your moving average as a indicator. Let's go on to another example. Over here we also have another support area, and then we can add the trade over here. This is the first candle that closed above this zone, so you enter the trade after this. And then your invalidation zone would be any candle that goes back down here, because then it's already negative. And then you also have a great risk reward for your upwards move or your bullish trade. Okay, I hope that's clear for everyone. And then let's go on with another example. Over here we can see that price did consolidate towards the trend line, towards the MA, but it did break down below it. But if you didn't know what was going to happen, then if the price is moving towards the MA, then your invalidation zone or your stop loss, if you're actually getting into a trade, would be at the first candle close below the moving average. So over here, this candle close would be your invalidation zone, and you would exit the trade. And then you would save yourself from this whole drawdown. Okay, now we have using the moving average as support and resistance zones. Over here we have the area to enter. And then you take a short trade, because as you can see, the price is below the moving average. So that's the important part of this trade. This is a support, a resistance area as well. So you want to make sure the invalidation zone or stop loss is over that area. This is also an area where you can see that price or the moving average acted as resistance. So any close above that would be an invalidation of the trade. And then you have fantastic risk reward, and you can start moving your stop loss into profit once the price keeps going down. Okay, so let's try this short trade again for this current area. This is where you would add your short entry, your stop loss, and as you can see in this trade, it didn't quite reach the MA for this case, and it just went back down. So instead, if you want to do a counter trade, so this is an area where you have support and you can enter a long trade. Your invalidation would be obviously at the break of this level. And then your take profit or exiting of the trade would be at the MA. Now, as you can see, it didn't reach it for this case. So instead, once it breaks this level, it would be invalidated as a upwards movement. So your take profit then would be at the break of that level, which would be over here. And it would still be a good trade, just not as great as you wanted it to be. Now, the best way to use moving averages for your trading are to combine it with price data and candlesticks and candlestick patterns. Combine moving averages with support and resistance zones. If you know how to use any, combine it with other indicators. Remember to be careful with fake out situations, so always use your stop losses and take into consideration that fake outs or fake breakouts might happen. Remember to verify and validate any rumors or information that are causing certain assets or commodities or cryptocurrencies to move in price. And lastly, control your emotions. Make sure you're not trading out of fear or greed or any strong, overwhelming emotion, but really with a strategy and plan in mind. Alright, so that's it. Now you learned within this video what exactly moving averages are, what are the different types, and which are used most commonly, and more importantly, how to use moving averages for your trades. Now, please make sure that you also finish watching episodes 1 and 2. These will greatly improve your trading knowledge and help you within the journey to become a more successful and profitable trader. Remember that if you found any part of this video entertaining, useful, informative, please make sure to like the video, and also please remember to subscribe and hit the bell notification. You won't want to miss out on any of our episodes. We're going to be giving away a lot of information and certain tips and tricks that can really help you become a successful, profitable trader. So make sure that you're subscribed and you stay notified and up to date on our next episodes. That was it for episode 3, where we discuss moving averages. Make sure to check out episodes 1 and 2 and our other series, which is Casual Crypto Chats, where we discuss different topics within the industry. And I look forward to seeing you in the next video. Thank you so much for watching and have a great day. Bye!